For this one, we're doing a non-monetary exchange, and we need to do journal entries for both companies. So we'll start with Phillips Corporation. First of all, Phillips Corporation has torn up a machine, and let's see, the account was assigned. So Phillips Corporation is giving the machine plus $680 to Luzinski Business Machine Company. So they're giving them a machine that they tore up in exchange for a new machine. So the machine that Phillips is giving, the old machine, we have to take it off of the books. So we would credit that old machine at the cost of the $580. We also gave Luzinski cash of $680, so we would credit cash for $680. When we take the machine off, we have to take the associated accumulated depreciation off. So it has a credit balance, so we would take it off with the debit. So those were kind of two things that we're taking off the books. Then we are getting a machine, and we're going to put the machine that we're getting for the $680 that we paid with cash plus the fair market value of the machine that we gave up. And so here the book value of the machine we gave up is $300, but we're going to go with the fair value because that's what it's worth right now. That's why we use the $170. So use the fair value of the old machine. And the reason that's included in the cost of the new machine is because in order to get this machine, we had to pay cash and we had to give away our old machine. Now, our old machine, the book value would be the $580 minus the $280 of accumulated depreciation. So the book value is $300. But the fair value is $170. So we're only technically getting the $170 because that's the fair value and that's what we're recording onto our new machine. So we actually have a loss. And so that's why you put the $130 there. It's a loss on your disposal of machinery. That one was kind of difficult as far as what to use there, but the fair value is what you want to use. For Luzinski, they're getting cash of $680. They're getting used inventory of $170. Now notice they're going to record inventory that was given to them at the fair value. They made a sale of $850. Because that's the fair value of the machine, the new machine they sold. The cost of, anytime you make a sale, you will debit cost of goods sold and credit sales. The cost of the goods they sold of the new machine was $540. And so they made this sale, and so they have to adjust inventory because now that inventory is gone. So they would credit inventory for $540. So you have the sales part, the debit to cost of goods sold, the credit to sales, but you also have to take the inventory off the books. So that one was a little tricky just because you have a lot going on in your journal entries. So just let me know if you have any questions.